Good day, everyone. Today we're going to discuss the merchandise inventory. We're still on the analyzing the unadjusted trial balance to record internal transactions or adjustments. So let's take a look at the unadjusted trial balance. So we're done with cash, accounts receivable, allowance for doubtful accounts, notes receivable, and supply. So we're now here in the merchandise inventory. So this is the next item that we're going to discuss. Merchandise inventory is the total cost of goods on hand and available for sale at any given time. Merchandise inventory, also called inventory, is a current asset with a normal debit balance, meaning a debit will increase and a credit will increase. I'm sorry. It has a normal balance, meaning a debit will increase the value of the asset and a credit will decrease the value of the asset. An inventory recording system has to deal with the recording of physical quantities of stock and its valuation. And merchandise inventory has two kinds of recording system. So we have the periodic inventory system and perpetual inventory system. Periodic inventory system uses purchases account to record all purchase-related transactions. Perpetual inventory system records all inventory transactions as they occur in the merchandise inventory account. Meaning to say, in periodic inventory system, merchandise inventory account is not used in recording external transaction. What is being used is the account purchases. So, in perpetual inventory system, merchandise inventory account is used in recording external transactions. Periodic inventory uses the purchases account in recording the increase in merchandise inventory and makes no record of the decrease in the inventory. Neither the cost of goods sold recognized during sales transaction. So only purchases are recorded. The cost of goods sold during sales is not recorded. Perpetual inventory system records the increase and decrease of the merchandise in the merchandise inventory account, and likewise records the cost of goods sold in every sales transaction. So in perpetual inventory system, the merchandise inventory account is being used as well as the cost of goods sold account. For purchases, merchandise inventory is debited, and for sales, cost of goods sold is debited and merchandise inventory is credited. Under the periodic inventory system, all purchases made during the period are recorded using the purchases account. The merchandise inventory account appears only when a physical inventory count is conducted. Since physical inventory count comes, since inventory count is really time consuming, few businesses do this more than once a year or more than once in a quarter or a year. When using the periodic system, the cost of goods sold and the cost of goods sold account is not used during sales transaction, and the balance shown as cost of goods sold pertains to the cost of goods sold determined as of the last inventory count and not for the current period. When a physical inventory count is done, the balance in the purchases account is transferred to the inventory account, which in turn is adjusted to match the cost of the ending inventory. The formula to calculate the cost of goods sold under the periodic inventory system is beginning inventory plus purchases is equal to cost of goods available for sale. Cost of goods available for sale minus ending inventory is equal to cost of goods sold. So, using periodic inventory system of recording, you have to compute for the cost of goods sold at the end of the period after conducting the physical inventory count. Unlike in perpetual, you have to just record the transaction as it happens. And then at the end of the period, you will have the balance in the ledger because you have entered all the transactions in the merchandise inventory account. So let's compute for the cost of goods sold in the periodic inventory system. For example, Tarimacor Merchandising has beginning inventory of 100,000, has paid 170,000 for purchases, and its physical inventory count reveals an ending inventory of 80,000 cost. The calculation of its cost of goods sold will be the beginning inventory plus the purchases during the period and then minus the ending inventory. So the answer will be, the cost of goods sold will be 190,000 because this is 270 minus 80. So you really have to compute for the cost of goods sold at the end of the period when using the periodic inventory system. Otherwise, you cannot have your net income. Under a periodic inventory system, inventory purchases made initially are stored in a purchases account with the following journal entry: debit purchases, credit, cash, or accounts payable. There may be a number of these entries during an accounting period which gradually increase the amount in the purchases account. At the end of the accounting period, the entire balance in the purchases account is transferred into the inventory asset account. This means that the purchases account is a temporary account for all the inventory bought during the accounting period. It is not an account which balance is being carried forward into the next accounting period. The entry to record all the purchases into the inventory record at the end of the period is debit inventory, credit purchases. The next necessary entry will be to record the cost of goods sold, to take this out from the inventory account because you have already entered all the purchases to the purchases account, and then the purchases account are transferred to the inventory account. At the end of the period, cost of goods sold is to be determined. So cost of goods sold is determined by adding the beginning merchandise inventory and all the net purchases during the period and deducting from the total of the amount the counted inventory as of the end of the period. The entry to record the transaction will, the cost of goods sold will be debit to cost of goods sold and credit to merchandise inventory. Another way to record the inventory and cost of goods sold is as follows: debit cost of goods sold, debit merchandise inventory, and credit purchases. So this is just a compound entry of the two entries presented. Relevant to the discussion of recording inventory using periodic inventory system is the recording of the sales transaction. Under the periodic inventory system, sales transactions are recorded without any recognition of the cost of goods sold. The sales transaction merely records the amount of sales. The decrease in the inventory is not matched with the recording of the sales transactions because the periodic inventory system only adjusts the inventory balance at the end of the accounting period. Thus, there is not a direct linkage between sales and inventory in a periodic inventory system. The following entry shows the transaction record under the periodic inventory system. So it will only record the sales transaction, and the deduction from the merchandise will not be recorded. So it will be a debit to either cash or accounts receivable, then credit to sales. This is the only needed transaction. This is the only needed record of transaction in periodic inventory system. The periodic inventory system is most useful for smaller businesses that maintain minimal amounts of inventory. For these businesses, a physical count is easy to complete, and cost of goods sold can be estimated for interim periods. However, there are several problems with this system. Delayed information. It does not yield any information about the cost of goods sold or ending inventory balances during interim periods. When there has been no physical inventory count. Errors resulting from estimates. The cost of goods sold during interim periods will only be based on estimates, which will likely result in significant adjustments to the actual cost of goods sold whenever actual physical inventory count is completed. Then we have these massive adjustments for obsolescence and losses. There is no way to adjust for obsolete inventory or scrap losses during interim periods. So there tends to be a significant and expensive adjustment for these issues when a physical inventory count is actually undertaken. Not scalable. It is not an adequate system for larger businesses with large inventory investments, given its high level of inaccuracy at any given point in time because there is no available updated records, except when the inventory is updated by conducting actual physical inventory count. And this one is the perpetual inventory system. So under the perpetual inventory system, an entity regularly and continually updates its inventory records to account for additions to and subtractions from the inventory account for such activities as received inventory items, goods sold from stock, items moved from one location to another, items picked from inventory for use in the production process, items scrapped. The perpetual inventory system has advantages for providing up-to-date balance information and requiring a reduced level of actual physical inventory count. However, the calculated inventory levels derived by a perpetual inventory system may gradually differ from actual inventory levels due to unrecorded transactions or theft. It is necessary to periodically compare the record per books and the actual physical count or quantities on hand and adjust the book balances as necessary. Perpetual inventory is by far the preferred method for tracking inventory since it can yield reasonably accurate results on an ongoing basis if properly managed. Okay, this is the example of transaction in a perpetual inventory system. To record purchases, we debit, for example, there is 1,500 purchases made by Terimakor. So that entry will be debit to inventory and credit to accounts payable. Now, to record the cost of freight, which is associated with the delivery of inventory, it will be debit to inventory and credit to accounts payable. The cost of freight in is added to the cost of purchases or cost of inventory. Now, to record sale of 3,000 for which the associated inventory cost is 1,800. The entry will be debit accounts receivable for the cost of for the sale or for the selling price, then the revenue on that. So debit accounts receivable, credit revenue. Now there is a corollary entry to record the cost of goods sold and the deduction from inventory. So in perpetual inventory, you have to determine the cost of the merchandise sold. So you can have a proper entry for the cost of goods sold during sales transaction. So debit to cost of goods sold for the cost of the sales and then credit to inventory. This corollary entry is not present in the periodic system of recording inventory. Okay, the next transaction is to record a downward inventory adjustment of 800 caused by inventory theft detected during an inventory count. So take note that there is also an inventory count in perpetual inventory system. But the purpose of the inventory count is not to set up the cost of goods sold or the ending balance of the inventory, but to reconcile the records per books and the actual number of inventory. So this is more on an audit purpose. It is more of an audit purpose rather than reporting purpose. So in periodic system, the physical inventory is a mandatory requirement to set up the cost of goods sold and merchandise inventory account at the end of the period. But in perpetual, it is not necessary because the ledger account shows the balance of the inventory and the cost of goods sold. However, physical inventory is still conducted to detect shrinkage and theft or losses. So in the physical count using perpetual inventory system, you will discover spoilages that should be considered as expense of the business. So in this particular case, there were 800 inventory found to be lost through shrinkage. So it should be taken out of the inventory. So debit inventory shrinkage expense 800 and credit to inventory. Summary of internal transactions on merchandise inventory. So if the method being used is periodic system of inventory, the merchandise inventory is to be determined through actual physical count to set up the cost of goods sold and to determine the actual merchandise inventory to be recorded as asset in the financial statements. The internal transactions will be the cost of goods sold, considering that there is no source document to support the journal entry. If the method being used is perpetual inventory, the internal transaction that should be recorded will be the losses and obsolescence found during physical count to check the reconciliation of the balance per books and actual balance per physical count. There is no need to set up the cost of goods sold because the perpetual system provides for the recording of the cost of sales during every sales transaction. If you are learning from this presentation, please don't forget to like, share, and hit the subscribe button for the latest update on this channel. Thank you, and I hope that you will continue to watch more of my videos. God bless, keep safe.